We're back with our featured guest, Lorne Steinberg, to compare a couple of important groups of stocks. Almost everybody owns them. The Canadian banks versus the U.S. banks. And despite the rally we've seen, Lorne, in the Canadian bank stocks since October, the market generally has rallied since that period of time. The Canadian banks continue to lag their U.S. peers.
Sure. I mean, listen, first of all, so much money, Paul, has flowed into the U.S. markets and things like the S&P 500 ETFs, which has fueled everything in the U.S., including U.S. bank stocks. And a lot of that money has flowed out of Canada, which is basically being ignored by global investors. The result is when we actually look at the earnings of U.S. and Canadian banks over the last few years, they're pretty similar. Sure, JP Morgan's an outlier and has done well, but nonetheless, but the U.S. banks have dramatically outperformed, leaving Canadian banks with an average 5% dividend yield, which means you don't need much to get yourself to a pretty healthy return over the next number of years.
You advise Canadian clients to have a significant weighting in the Canadian bank shares?
Sure, we have a significant weighting today in the top 5 Canadian banks, and they're all somewhat different. And you know, a couple of years ago, TD was the bank to own. It was doing incredibly well. And BNS has been the laggard. BNS gone through some changes recently in the right direction, and it's picking up. And now TD has its U.S. issues with anti-money laundering, and now offering a dividend yield of over 5%. But for us, I mean, this is a core area. Canada's a growth country. We still have plenty of immigration. Canadians are getting wealthier, and the banks are benefiting from all
that. That
this.
was my next question. I mean, a lot of people say that the reason the Canadian banks are underperforming the U.S. banks is that the Canadian economy is underperforming the U.S. economy.
Canadian economy is underperforming somewhat, but the banks are somewhat different as well. Canadian banks are a little bit more retail focused. The U.S. money center banks more in other businesses as well. But we don't think that's really the reason. In fact, when we look at kind of loan growth, we're expecting similar loan growth in both countries. Non-performing loans, Canada will probably do better than the U.S. because the banks have been protected by the mortgage legislation, which has pushed a lot of riskier borrowers off to non-bank lenders.
Right.
So Canadian banks, I mean, we're looking for earnings growth over the next few years.
What about the narrative that that as mortgages roll over and many mortgage holders have to renew mortgages at much higher rates of interest, that they will spend their discretionary spending on other things will contract, weighing on the overall Canadian economic picture?
That's 100% true. There's no question about it. We'll see it in the consumer spending numbers, you know, the data that's coming out. But in terms of, the banks are more susceptible to non-performing loans versus consumers pulling back on their other types of spending. In fact, if we see a rate cut or two, we should see, you know, continued improvement in the housing market in Canada, which would mean increased mortgage origination, which is a huge business for banks. And the business lending side remains rock solid. The U.S. is also having issues because with their 30-year mortgages, houses are not being sold in the States, which is impacting the U.S. banks on the mortgage side.
The problems at TD Bank are serious, clearly. How serious are they from a shareholder point of view? Would you buy TD at these levels? It's underperformed for obvious reasons. It's facing a big regulatory problem in the U.S.
Sure. First of all, we would buy it today. Listen, these things always fade over time. TD's already put aside $450 million US. Could it go as high as $2 billion? As some speculation is it's possible, still a drop in the bucket. Bigger issue will be, will there be other penalties? Will TD in the US be forced to cap their asset growth? That has happened in the past with other banks. Very possible. The US regulator is really, really tough. And that could slow TD's U.S. expansion plans down for the next 5 years, possibly. But there's enough growth in this business, and where the share price is right now, it looks like compelling value.
Which bank stocks do you own on behalf of clients?
We own the top 5. So TD, Royal, BMO, BNS, and CIBC. They're all a bit different, but they all look like very cheap stocks.